Hello, everybody. Welcome back to our financial strategy series. In this episode, we'll be focusing on high income earners and tax strategies to pay the least in taxes. So, whether you're a successful entrepreneur, a top executive, or a professional with high income, optimizing your tax strategy is going to be important to preserve your wealth. But before we get into our topic, let me introduce myself. So, my name is Shane Harris, and around here on these social media streets, I'm also referred to as Shane the Negotiator. And I help coaches, consultants, and service providers who are overwhelmed and lack guidance to achieve true financial freedom. And I do that by providing expert tax and coaching services. That is what I do. That is who I help. So let's get into today's topic: high income earners and tax strategies to pay the least in taxes, because nobody got time to pay more taxes than necessary, right? So, understanding tax liabilities for high income earners. So, high income earners often face progressively higher tax rate, which is self-explanatory. Why? The more you make, the more taxes you pay, right? Which can significantly reduce the net income. That is your total income after all of your taxes and everything. What is remaining is your net income. Understanding how to navigate through tax deductions, credits, and strategies and strategically planning investments can mitigate these liabilities. So let's go into maximize retirement contributions as we speak so much about. So one of the most straightforward strategies is maximizing contributions to your retirement accounts. So we have accounts like 401ks, IRAs, and especially Roth can offer tax benefits for higher earners. Maximizing these contributions not only defer your taxes, but also you can invest your money in advantage ways. So when I say defer your taxes, it's because if you are investing into your retirement plan today, so today I am 45, I think sometimes I forget, but I'm 45 right now. So if I was going to be a high income earner and I invest into Roth IRAs and 401ks and all these other plans that's available out there, I can defer the taxes. Well, not Roth, because Roth is money that you pay in after you pay taxes on that money. So I'm talking about like 401ks and IRAs. I don't want to make a slip in the tongue and confuse you. So if I invest into those 401ks or those IRAs today at age 45, I'm saving the taxes to pay those taxes later. So the money is going to come out pre-tax, before tax. Is going to come out of my paycheck or out of my self-employment wages or whichever. It comes out before the taxes are taken out. So the tax is going to be referred later. So after 65, well, the way things are going, it could be 70, or for some of the business plans like those 401ks and IRAs and those SEPs, you can take them out when you're about 70, or I mean, you then will pay taxes on it at that time for some of them. So the taxes that I will pay now at age 45 is going to be significantly higher than the taxes that I would pay when I'm 70, 65, or even 70, and for some 72 for certain plans. So I rather pay the tax on it later, because my age, my old age in my 65, which is not old, I'm just saying it for tax purposes. The age when I'm older at 65 or at 70 or at 75, whichever age after 65 I decide to take it out, the tax is going to be significantly lower than the taxes I'm paying right now at age 45. So yes, that is going to be a powerful way for you to defer taxes. It's going to save you in the long run. So investment strategies. So investing in tax efficient securities like those municipal bonds or certain mutual funds can provide income that's exempt from federal taxes and in some cases state taxes. Additionally, using strategies such as the tax loss harvesting within your investment portfolio can offset capital gains, which are losses that are incurred throughout the entire year. So the losses that you get from investments, you can offset those gains that you receive and have the losses offset those gains that you might get. So let's go into some real estate and charitable contributions. Investing in real estate offers depreciation deductions, while charitable contributions, especially appreciated assets, can reduce taxable income and, of course, avoid those capital gains. Setting up a charitable remainder trust can also defer income while fulfilling your philanthropic goals. So I've spoken to you guys about real estate and charitable contributions in the previous sessions. Go back to the 2023's playlist, Pathway to Financial Mastery, and of course the 2024 playlist, and it's going to have various topics. In 2023, we did speak about, or it might have been 2020, yes, 2023 or early part of 24. We did speak about depreciation on real estate and how that can be beneficial. And we also talked about charitable contributions and how that can be beneficial. So when you get into the higher income earners, and what I consider higher income is if you're starting to get close to those thresholds. So if you're making 250K, 300K or more, you're in the higher income earner bracket. Now, there's a difference between gross and net. If you gross 350K, your net may not be 350K. Your net may be a lot smaller than that. So I'm speaking about high income earners whose net, meaning after deductions and credits, not deductions, after certain expenses that you might have paid in your business, your net amount is 250K, 350K or more. That's what I'm talking about when I say high income earners. However, you can still be a high income earner at a net of 200K as well. So I would say anything 6 figures and up is considered higher income earner if that is your net. Okay. So having those charitable contributions can definitely help to offset some of this income by offloading it off. So you're donating to receive that tax break. So it's a win-win for everybody. So let's talk about a case study with Dr. Thomas. So Dr. Thomas, a high earning surgeon, diversify her portfolio to include municipal bonds, resulting in tax-free income. So municipal bonds are on the federal level and it's tax-free interest income. She also maximized by adding into her 401k contributions and made a significant charitable donation of appreciated stock, subsequently decreasing her taxable income. So if her taxable income was 300K and she dropped 100K into a mix of her into her charitable contributions and also those stocks, then she would have reduced that 300K by 100K. So now her taxable income, instead of being 300K, it's now 200K. And of course, there's other deductions and credits that she can get and be eligible to take. So advanced tax planning techniques. For those with businesses, strategies like the income shifting through your employment, employing family members, or establishing an S corp to take advantage of lower tax rates on dividend income can be beneficial. Also, ensure these techniques align with the IRS rules and regulations to avoid scrutiny. You do not want to get into any trouble with the IRS by doing anything shady. Tax avoidance versus tax evasion. Tax evasion is illegal, tax avoidance is legal. So what we're talking about here is tax avoidance by shifting your income. So employing certain family members, there can be some perks by employing your parents or your children. Of course, similarly, if you have an S corporation versus paying all of those taxes, 15.3% in self-employment taxes, if you have a corporation, the corporation pay taxes and you as the employer, which is the corporation, the employer pays taxes, you as the employee pay the other half of the taxes. So again, it's essentially splitting taxes with your business. So it's a lot better than being a sole proprietor making 350K versus, or an LLC with a single member versus you being a corporation. And of course, hiring those family members. So utilizing some of the tax credits, so tax credits such as for education expenses, which we have spoken about previously, renewable energy investment, or hiring specific groups of employees can offer dollar for dollar reductions in tax liabilities. High income earners should ensure they're taking full advantage of the available credits. So if you are considered a high income earner, you definitely, and I'm saying this, If you don't listen to anything else that I have said, you do not want to file your own taxes unless you are in taxation, because you are for a fact 100% missing out on certain credits and certain deductions that you will be eligible for. It's a lot of income for you to be playing around with, and you will essentially be paying thousands and thousands of in taxes that you otherwise do not need to pay. So professional guidance is key. Given the complexity of tax laws, consulting with a tax professional is going to be invaluable. It's going to be one of your most valuable assets. They can provide, they and we can provide personalized advice tailored to your specific financial situation, helping navigate the maze of tax saving strategies effectively. So, in conclusion, for high income earners, effective tax strategies is not just about reducing taxes in the current year, but it's also about setting up your long term plan that optimizes tax liabilities and support wealth preservation and growth in the long run. So let's get into some teasers for the next one. So stay tuned for our next session. We'll be navigating additional Medicare taxes, where we'll be exploring strategies for managing this specific tax liability for higher earners. So this is going to be in continuation from this session. We're going to piggyback off of this and move into Medicare taxes, additional Medicare taxes, when you start to make a lot of money. It's a must watch for anyone looking to understand the full scope of their tax liabilities and their tax obligations. So I'm going to drop my link, which is going to be scrolling across the screen, or actually it's sitting on the screen, bit.ly/SD negotiator. If you are looking for a professional to help guide you through the maze of taxation, and especially if you are a high income earner and you're looking for someone to help you with tax planning and to get all of your structures in order so that you can pay the least amount of taxes, click that link, schedule a 15-minute chat. However, this is just an overview for us to go over if we're a good fit working with each other. I would advise you to schedule a consultation, which is going to be for an investment where we can really sit down and talk about your finances in more details. Okay, so in closing, thank you for tuning in today's session on tax strategies for high income earners. If you please subscribe. If you are watching this on some of the other platforms, follow me, subscribe, friend request, whichever one you like. Drop a comment in there with any future topics that you may want me to discuss. If you have any questions about the current topic or any topic that we have dropped previously, drop them in the comment. I don't know what you guys' struggles are if you do not say what they are. Do not suffer in silence. It's time is 2024. We're making changes. We're not doing the same things that we did last year. It's time to elevate and progress and move forward and grow and scale individually and, of course, in our businesses. Okay, so here's to a smart tax planning and greater financial health. And until I come back with the next awesome topic, I hope you guys have a great and wonderful